Give us 30 minutes each week to discover the trends that are shaping the future of retirement with That Annuity Show. We bring you conversations with industry leaders who are revolutionizing financial products, technology, and distribution channels. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another great episode of That Annuity Show. And today, Ramsey, you are the co-host with me. Good to see you.
Indeed. Always good to be back on the show. We are super delighted to be joined today by Philip Chao. So as some in the audience may know, I'm building a business that's very focused on the 401k space, bringing income, guaranteed retirement income specifically into the 401k space, into defined contribution. And I can tell you that one of the leading voices that I hear consistently in many venues at conferences, in LinkedIn and elsewhere is Philip Chao. And so we're really excited to have him here today and want to learn more about what brought him into this space. What are the sort of the unique attributes that he's brought to the discussion, and there are many. And then we want to get to know him a little bit better and see what the future holds for this particular really major opportunity for the asset management and the insurance space. So with that, Philip, please tell us a little bit about yourself. Tell us about your company, and then how you came to start focusing on guaranteed income and 401ks.
So I'm going to cut this discussion really short because there's a lot to talk about. So thank you first of all for that generous introduction, and thank you for inviting me to be on your show. And it's always wonderful to see you both. And so a very quick story. I have three companies that's probably relevant to our discussion. One is Experiential Wealth, is a wealth management firm. And why is that important? Is that through wealth management, folks like me who are investment professionals, my role is to provide not only financial advice, but to actually do the cooking in the kitchen for asset management on a discretionary basis, putting in public and private assets for very high net worth individuals and small institutions. That's the framework. And why is that relevant to our discussion? Really twofold. One is really understand people's needs on a ground level, to understand the individual, not just some average participant. I have no idea what an average participant is, but really sit down with clients over the last 30 years, understanding what their objectives are, what do they want to do, how do we help them solve lifetime income issues, how do we meet their objectives post-retirement, as well as estate and everything else that you all, probably the audience, understand. So from that standpoint, I think it's very relevant because it gives me a real sense of understanding of what people are looking for on average. Now, nobody's average, but at least have a real sense on how some of these challenges are and how we solve it on a one-on-one basis, which is not how retirement plan is designed. We're solving for the masses. So try to take that information and bring it back, widen the aperture and say, how can we get as close to that as we can? So that's one aspect. The other aspect of experiential wealth experience is that investment. I mean, at the end of the day, it's about creating the accumulation necessary during lifetime so that decumulation can happen. So you can't talk about decumulation without talking about accumulation. And if you talk about accumulation alone without talking about decumulation, it's kind of silly as well. Hence the name of my firm, which used to be Chao and Company, and which is somewhat meaningless except to me and my ancestor, which is also meaningless. So I changed it to Experiential Wealth because it's not what accumulating money, but it's what money can do for us in lifetime experience. So I changed it to Experiential Wealth. So that's one. Quickly, two is I started a company about 5 years ago by the name of Nexus 338. And Nexus 338 stands for, supposed to stand for ERISA 338. So Nexus 338 is really connecting things together and serve as a 338. That's where I come up with this term, Nexus 338. What is that trying to do? It's trying to figure out a way to personalize investment. So taking my experiential wealth experience into retirement plan and say, well, not everybody can afford or want to hire an individual to help them or a firm to help them. And they are unable or unwilling to participate in their investment duties, shall we say, and they kind of leave it there until it's a little bit late. So what we were trying to do is say, well, how do we help them to create portfolios without a lot of attention by them? So far, up until a few years ago, it's just simply a target date fund, which is fantastic advancement from a single factor, I want to buy stock, or single factor, I want to buy bonds, and then try to figure it out yourself. We barely are good investors. We're barely good savers. We're terrible investors. So I thought about that. Yes, sir.
I just want a quick sort of clarification for the audience. Not everybody in the audience will know what the role of a 338 is. And I think given everything that you're telling behind it, it's super important. So just for the parts of the audience that may not be as familiar.
I have not heard of a 338 before.
What is the role of a 338?
It's not Magnum 338, so let's just be clear. 338 is under a section of the ERISA code that talks about hiring an individual or a firm to serve as a fiduciary investment manager with discretion. So that's different than a 321, just in case we want to know nomenclature. A 321 is hiring somebody to give you fiduciary investment advice. The difference between advice and management is one actually do all the work and take on full liability and responsibility. The other one is helping you to make your own decision. So 338 is me, my firm, coming into a retirement plan environment to create portfolios that we can take on full fiduciary responsibility, thus liability, of creating portfolios for each individual. So thank you.
So this business, your first business, experiential wealth, is largely high net worth individuals. Plus, there's some small institutions. Nexus 338 is purely an institutional service. Is that a fair description?
Correct.
Okay.
When we go by institutional, let's not scare anybody. This is really for retirement plans, which we do call institutions, because our client is not actually the participants. Because the assets, by the way, most of people don't know, the assets in the plan don't belong to you, it belongs to the plan. It is the plan asset. And it is that framework is how ERISA came about in saying, hey, for as long as the money in the plan, that's plan asset, we're going to hold the plan sponsor and plan fiduciaries fully and wholly responsible for its performance, for its prudence, and so on and so forth. So my role is to be hired by plan fiduciaries or plan sponsors and say, hey, we know how to set up a plan, but investment is not our forte. We'd like to hire somebody who knows, this area and help us to make sure that we are prudent. So my role then is to help to create solution, in this case, to personalize, which I mentioned earlier, a retirement investment. So let me stop there for the Nexus 338 piece, because I can go on and will be very boring. And then finally, another company that I own is called Independent Fiduciary Services. About 20 years ago, my office got a call and said that we want to look for Philip Chao. And okay, we heard that he provides trustee services. And my office said, no, we don't do trustee services. Oh, yeah. No, we're referred. He's the guy. We have to go with him, and so on. Anyway, long story short, I really didn't do fiduciary trustee services, directed trustee services, but I know a lot about what a fiduciary should behave like, and I know how important that role is. So I said, well, many times I go in front of clients, and I tell them, you shouldn't do this, and they're finger pointing them, you should do that. No client so far, at least until then, have said, and what do you know about being a fiduciary? Have you ever sat in our seat? I would have said no. Right? I would have to say no. So I said, no. I'm going to sit in that seat, and I'm going to get people point finger at me, and I'm going to do the best that I can. And so starting then, 20 years ago, I took on the role of a directed trustee for health and welfare plan, not for retirement plan in this particular case. And that company continued to be here today, is helping plan sponsors who have health and welfare plan that have a lot of money that because they're government contractors, that they have to put money in. And as a result, they need a third-party independent voice. And so I serve in that capacity, and I remind myself all the time, what does a trustee in an ERISA standpoint as a fiduciary, what are my duties? So the combination of three, which I took forever to explain, is all related in kind of a weird way, but I think it builds on each other. And the glue of it all is serving in the sole interest of my client. And always remember, that's my duty to the public. So let me stop there to see if you have any questions.
So the last one, independent fiduciary services, just for my edification. So if there's a board of trustees, you would join somebody's board of trustees as a third party trustee, as a service to a plan.
Not quite, but close enough. So if you are a plan sponsor, and let's say you have 1,000 employees and you need to put money into a trust, for that trust to be an independent third party, so there is no conflict between the plan sponsor and the service provider and everybody else, right? No different than, say, you're familiar with retirement plan. Many of them hire a third party trustee like Schwab or State Street Bank or what have you. Their job is to make sure that money comes in, money goes out, and they're operating in accordance to the plan document and all the things that a fiduciary should do. I am that one person or that institution for health and welfare plans. So plan sponsor appoints me. There is a trust. I am the named sole trustee. I am the only one who have authority over any of the money, because it cannot go back to the plan trustee. It can only be paid out for specified distributions that is stated so in the trust document. So part of this is to manual work and basically payment. But on the other hand, it also give us an opportunity sometimes to come in, and I've helped number of clients who have, one client have been sued by the DOL, and hence they hired me after the fact to hire an independent trustee. And I helped them to go through that entire process. It was a fantastic experience for me, because that you truly understand what's going on. And it took many years, and there were fines and so on. So that was my job. And I kind of like it in the sense that I really helped to inform me, and I have the authority to say that I've been through it. And I think that's really important.
Well, really interesting, Philip. Ramsey's been great about sort of, pulling in a lot of people in around and talking to the in-plan annuity market. And I think for certain groups, it's kind of plug and play, slightly different product. For others, especially some retail annuity players, it's like, well, wait a second, explain what 401ks work. Let me just ask a question from a carrier standpoint. So imagine I'm a business development, head of strategic planning, trying to figure out, like, I've read all this stuff, I've read all these reports. Looks like it's an opportunity. Is my carrier in a good position, or, we've got to do a lot of work to get there? What type of carrier is really natural to this? I'm presuming it's a carrier who may be in the PRT business, maybe doing some sort of GICs that are being sold already into this thing. They've got more of an asset management group. Tell me what carriers really just sort of naturally come into this market?
So thank you for that question. I'm actually working with a couple of carriers right now who are interested in the employment. When I say employment, I'm talking about the employer space, which is in-plan space. I think that's your question.
Yes.
What is the right carrier? I don't think there's a right or wrong carrier. So there are carriers who basically took off-the-shelf ideas on the individual market and create group products that have some of the bells and whistles, but certainly not all the bells and whistles. There's a pricing change, obviously, because in ERISA, the duty to control plan expenses and without conflict is critical, obviously. So many times that, and this is where I think a lot of misunderstanding and very unfortunate. And why I say it's unfortunate is only because people have a very bad impression of annuities for right reason or wrong reason. But in-plan annuities is not your father's annuities anymore. It is very different. It's really a payment system, a guarantor system that makes sure that you will not outlive your income. and there are no death benefit to speak of. There are no other, long-term care benefits that come out of it, so on and so forth. Because the insurance company, if nothing else, they are very creative. And what they have done is to say, how can I make this knife a Swiss Army knife? It can be all things to all people. And because it can be all things to all people can buy from me. Well, in the retirement space, in the employer's space, we don't want to be all things to all people with this knife. We only want this knife to do one thing. So because it only does one thing, I think that you can lower the cost and take some of the best ideas in your annuity, individual annuity, make it into a group annuity that is tradable. We'll talk about, I'm sure, connectivity momentarily. And so that it can be made available in plan. After you have created those products, you have to figure out, how am I different? Is my rating better? Is my crediting, is my investment better? Am I able to give better return? What is my track record? All those type of things. So not everyone wants to be in it, but the people who are in it, I always think about, and Ramsey probably agrees with this, what differentiates you? I don't want another Me Too product. Everybody has a product. So what? What separates you? And I think that we, of course, like everything else, when there are trillions of dollars at stake here, trillions, everybody just want to say any product is better than no product. We want to have a seat at the table. And so it's like Kenny Roger chicken restaurants. There are just way too many. And then they say, oh boy, I overbuilt. And then they're going to collapse it. So I think we're going to go through that in the insurance space as well. We're going to say, oh my goodness, everybody going to rush in because there's a gold rush. And we'll all of a sudden say, well, we never asked the question, how are we different? What is our marketing strategy? What is our distribution strategy? How are we better under what circumstance? And those are really the questions, in my opinion. I think all insurance companies have the ability to, if they are already in the annuity business, to be in this in the retirement space as well.
So if we think about that arc where we're sort of early in the cycle and then the cycle grows and maybe overshoots and then there's some consolidation, I certainly have an opinion on where we are in that arc. Where do you think we are in that arc right now?
We are probably a quarter in at most.
Yes.
A quarter in at most. And one of the trickiest thing of them all is that every insurance company come in with a little bit different twists, not to differentiate, but a little different twist for business or other purposes. A lot of it has to do with distribution. I built this fantastic thing and nobody knows about it. What good is it? So how do we create this thing in such a way that record keepers and intermediaries will latch on and let people know about it, right? So the vehicle by which they build it have something to do with how they think about distribution. So I'll give you an example. A lot of people are not just building a single annuity anymore by themselves. Certainly that's available. And God knows, nobody go and say, gosh, I can't wait to stick all my money in annuity on the lineup, on the core menu lineup in the retirement plan. If you find that person, please introduce that person to me. Most people don't know annuity and they find it strange. And is it really an investment? All that type of stuff. So they all want to be part of something. So today, I think there was an article I just kind of commented a couple of days ago on LinkedIn that came from a study that was highlighted in the Plan Advisor or Plan Sponsor magazine that talks about how annuities are really now very much part of a target date fund suite. Because it's the vehicle by which you can put annuity in and for the betterment of the public, but without having to deal with, do I need it? Do I not need it? So I think those are the discussions that the carriers, as well as the other intermediary, I'm talking about, 321, 338 people are also looking at and saying, well, how do we make this easy? And how do we put this into a default so that people don't have to make decisions because we know this is better for them?
Yeah. Well, let me double click in terms of on your comment, question to go about just being smart about where you're headed as a carrier, as a player, technology player in here. And Philip, just give you a little bit of my background. Way back when I started out, I was one of my projects at MetLife was, hey, look at the strategy for our 401k plans. Oh, that's because of a bunch of acquisitions. We had you can't make this up, Ramsey, 4 401k providers. And it went everything from, Philip, the 20 company plan all the way up to these monster plans that have been around forever and ever. You know some of the big names, the car companies and stuff. And wow, what a wild difference in terms of the products you put in, the investment products, the way you go to market. If you think about this one, and I would start, I guess, on 2 areas, technology and also product. Is there going to be a real difference in the products? And I'm probably not asking the right question, but what does it take to get into these sort of small businesses with the small 401k plans who want to put an annuity versus, I'm going to a giant employer, one of these one of these state plans, one of these large company plans, and I'm going to put a product in there. Where do you say, wait, stop, Paul, don't do this unless, you do this for these markets?
So for the small markets is where the future is. Look, there are only so many large companies. So the truly institutional market is not growing. I mean, growing by assets, but not growing by number of nationals. Where the growth is the small end of the market, and it's very well recognized. So a lot of folks are now looking at PEPs, right? And pool employer plans, where you pool employers together, creating one single plan, cut the expenses, but it's more, this is a single lineup, this is what we have, and people just join it, and administratively more efficient. The ideal is that everything costs less and it's more efficient, and give you the protection, and it's a clean, and you don't have to worry about anything. Just pay a de minimis amount of money, and everybody's happy. That's the idea. So to answer your question, then, is really aggregating all these small companies to become a larger company, if you would. Okay. So you're right. You asked the right question there in terms of how do we differentiate our products, or our point of entry is in the small end or the large end or the mid-size. I think Ramsey's question was this arc. Where do you think we are? I think ultimately it will be a non-issue. Everyone will have some kind of guaranteed lifetime income in their plan, right? So we no longer have to worry about it. But I think we're going through this transition now. This transition may take 10 years to get to that end of that arc. And so I think doing the work for smaller non-PEP, and I would non-aggregated, is probably a little bit more expensive. Obviously, they don't have the scale, right? So if you're only targeting 10-man companies, you don't have the scale. So depending on who the product provider is, I'm just going to name one: BlackRock. BlackRock has a product that has built-in annuities. Yes, there's some difference in pricing, I'm sure, between a Microsoft and Philip Chao's company. But the distance is not so wide because they have scale, right? I think $16 billion went into it, some number, huge number. So they have scale, and so we can take advantage of that scale, even though we're smaller. So I think it's really 2 questions. One is who the audience is and what their size and scale, but equally who the product provider is, what is their size and scale, right? If they have the size and scale, this size and scale become less important. If they don't have the size and scale, then this size really make a difference. I didn't really give you a good answer, but that's how I think about it.
So I'm gonna take a sec. I'm gonna take a second because I think we've covered a bunch of interesting things.
Sure.
And again, this is my key area of focus. So I'm again very excited we're talking about this. So essentially, sort of identified there's this need for guaranteed income. Identified that in order to bring it into the 401k, probably the best way to do that is to be part of the target date fund, because that's That's sort of the tool of choice for most 401k plans. And it's important that it's the default so that people don't have to go through the process of deciding to get it. It's something that is given to them, and they can opt out if they so choose, right? So that's sort of where we are. And then we can get into some other choices about, and I think this is very important specifically for you on some of the important contributions you're making to this space, is this idea of like, okay, well, what is it? What is a target date fund, right? So target date fund traditionally is stocks and bonds, right? And then there's one factor that determines the weighting between those stocks and bonds. So now we're introducing a new asset, which is the annuity. But then the question becomes one of, well, is how many factors should we think about and what are they? And then somewhere down the road, there's managed accounts. But you have a product that's IGPS, right? Tell us about that. Tell us about the factors that go into it, how you chose them, and why you think it's so important, an important sort of part of this journey.
By the way, I didn't pay Ramsey to ask me that question. Thank you for asking. I wasn't going to bring it up, but thank you. Thank you very much. Thank you. So we think about target date fund. Let's just go back and talk a little bit about target date fund and what the wonderful thing and what the challenges are. The wonderful thing is that if you look at where we are, so the world is relative, life is relative. We started with, here's 300 funds, go get them. It's like, what? I have no idea. Do I just look at yesterday, the best performer, which chances are not necessarily tomorrow's best performer? So it was very confusing and it was very difficult. So target date fund came about. And it was truly enhanced because of 2006 legislation that made it a QDIA, which stands for Qualified Default Investment Alternative. Basically, what it means is that if an employer, if a plan sponsor selects a target date fund, which is a multi-asset fund, prudently select it and prudently monitor it, if you meet all those standards, then they are relieved of fiduciary liability about that product, the performance of that product. In other words, I've done my best to get you the very best. Nobody has a crystal ball to tell the future. If you want to sue me, but my liability is very truncated because I have met all what they call safe harbor rules. So that's a QDIA. And so target date fund, basically how it's built is saying, we think that as we get older, we should take on less risk, and until retirement, we should take on even less risk. And sometimes I flatline from that point, is called 2. And then sometimes I continue past retirement, keep lowering risk. That's called through retirement. Doesn't matter. The idea is, okay, so if everybody is getting older, that's for sure. We know that. So every 5 years, we will step down a little bit more on your exposure to risk, which meaning exposure to equity risk, right? Because that's the one that's most volatile. And so every 5 years, you get the step down. You go down, 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 down. Okay. So that made a lot of sense and it was easy, and it's in 5-year increments. So if I am, 40 years old, all the people who are 40 and 37 and a half and 42 and a half, male, female, whatever, transgender, you name it, any kind of people, they are all in this. Doesn't matter how much I make, doesn't matter any other distinguishing factors. Is it good? Heck, it's a lot better than before. Can we do better? Heck, yes. That was sort of the idea. So how do they build target date funds? What they do is they go to eBRE data, they go to US Treasury data to find out what's the average income of an individual. What is the average account size of the individual? What is the average outside asset of an individual? What's the average age they're going to retire? What is the average contribution rate of a participant? What is the average employer contribution? Those are sort of the standard factors that's required to make this thing what they call a glide path, right? You're going from high and slightly glide down to low equity. So those are all national averages. And what I learned years ago, the word average, meaning that 50% of the people is above it and 50% of me must below it. I don't know which side I'm on, but I'm not on it, right? So there are the challenges. So it's not bad, but how can we improve on it? So the way to improve on it, I took a chapter out of managed account, because what managed account trying to do is say, hold on for a second, not everybody is average. So why don't we take individual real data and plug it in? How do we get that? Well, in managed account, you actually have somebody engaged, right? And that's why they charge you more money. I mean, a lot more money. And I understand, because there's a lot more work, the connectivity, blah, 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 all the things that are required. But there's I think it's called oxymoron. What is the oxymoron? If we put these type of investment in a QDIA, meaning people are unwilling or unable to make investment decisions, it doesn't make sense, because you require you to be engaged. Right? A managed account requires you to be engaged, to put that data in, not one time, but ongoing. Well, hold on. You're charging me a whole bunch of money. I'm not engaged, and I'm not getting any better. I'm just no different than a single factor target date fund, because what am I doing? So that's why lawsuits are filed, class action suits are filed, and it didn't make any sense. What I decided to do is say, why don't I take the best of both worlds? Why don't I look at target date fund idea, where you roll down your risk as you go into the future, open up 5 data points that individualizes your actual date of birth, not 5-year increments, your actual salary, your actual account size, your actual deferral rate, and your actual employer contribution rate. At least we have that. If we have that, we can project forward based on your real salary, not average salary, of what your future income going to potentially look like at normal retirement age. Then we can also project better on your individualized Social Security. So it begin to personalize. Is it perfect? No. There's nothing as perfect as getting an engaged client, right? Because engaged client is not only engaged now, by definition is engaged throughout his or her life. There are only 3 of those, and I probably don't even have one of the 3. Right? You know what I'm saying. So managed account has its challenges, even though it's tend to be going for the perfection. So what I did was I said, okay, if we can open those 5 data points and put individual information data in there, because those data sets are naturally available on record-keeping platforms. So we don't need a participant to be engaged. Hence, it fits QDIA. Take one more step. Because of that, I also believe that annuities should not be just, let's throw a slug in there. That's it. That's good enough. No, I think we should personalize annuity as well, right? Because of all these different variables and factors. And every quarter we rebalance, because you may have new data coming in. Your salary gone up, your salary gone down, you got bonus, you didn't, or you change your contribution rate. So we're constantly rebalancing if data changes. And so the idea is, how do we personalize a target date fund, even though it's not a fund, it's a service. So I call that IGPS, Individualized Glide Path Solution. And we are looking to put annuities in it now, sometime the first quarter this year or second quarter. And that will be called IGPS Lifetime, because we're talking about lifetime income. So that's the idea. And so far, we are very, very fortunate, very, very lucky. We launched it a little over 2 years ago. Launching means nothing until you actually get distribution. And so we seriously started distribution about 1.5 years ago, and we are going to top out around $350 million in this idea by end of the month.
Oh, interesting. Well, okay, I want to go. You mentioned engagement.
Yes.
Right. Now, I just got my email, which is from our company. Hey, open enrollment. Better come in and do this now. Click, click, click. All it is on-screen clicks. How did you get the $350 million? What type of engagement did you need with the participants to actually get them to put money in?
Once it's in QDIA, we don't need any engagement. that was the whole point, right? So you're absolutely right. We have found from behavioral finance and from many other reasons, sometimes it's better to not be engaged than engaged. Because once we engage in a way, oh my goodness, my account lost $3,000. I got to sell it. I can't do. So we want them to actually not engage, right? We want to feed them. I no longer want to teach them how to cook. I want to feed them. I know it's not as perfect as if they really learn how to cook and be a fantastic chef, but there's only so many fantastic chefs. I want to feed them. I want to find the best nutrient. I want to find the best food. I want to cook the meal that they will enjoy and is good for them. Is it perfect? No. But is it a significant improvement based on human behavior, based on lifetime of understanding of investing? Yes, it's much, much, much better.
So look, I think this is one of the critical elements of this particular space. One is sort of this realization that a 401k plan has lots of moving parts in it. There's lots of vendors. The other is that it's an institutional sale as opposed to an individual sale. So you're selling to the plan sponsor. And then all these considerations that you've highlighted that, what can you do with the information you're given, right? That actually brings it past that one factor, that's the story of many averages, and get you as close as possible to the benefits of a full engagement, where full engagement is impractical for behavioral issues, account size issues, and any number of other things. So then I guess sort of the next question then becomes one of so you said we're sort of a quarter of the way in the process, because the adoption cycle is something that's actually, the adoption cycle is I'd say early days on the supply side and the demand side. So there's still a lot of work for more carriers and asset managers to be involved in this space. That's certainly what we're focused on in Alex Income. But the next piece is so the plan sponsors, what do you think it's going to take to continue to move that needle? Is it marketing? Is it being on the road? Is it education? How do we get there?
I think there's so many pieces, right? So there are many strands to get to. It takes a village, I guess, right? So number one, first of all, we have to coalesce and say, yes, this is an important component. And based on my lots of analysis and discussion, we look at the glide path. We look at, when I talk about glide path, I'm talking about personalized glide path. Let me step back just a moment. And that I posited to a brilliant investment person who does glide paths for a living, who's a friend of mine. I said, based on the national average, now I'm going to go back to national average, how many dollars people save and what's the average value in their account? And I said, the ideal is that we can replace 65, 70% of their income, including Social Security. Forget about cost of living adjustment. Let's not go too excited on that for a second. But just to replace their pre-retirement income by 65%, how much annuity do we need? And the answer came back is, you stick the entire account in there is not enough. Fascinating. So think about that for a moment, right? This is not what the industry talk about. The industry says, oh, no, you need guaranteed lifetime income, so you have an extra paycheck and you will live forever and you're going to be fine. No. Not at all fine. That is just one piece. Even if you stick all of it in, it's still not enough, because we have undersaved, we have underinvested, we have underinformed. So that is a travesty if we tell people that if you have lifetime income in it, you're going to be great. That is not true. It's better, but not great. Some would be great if you're making $40,000 a year. If you make $300,000, it's not great. If you make $180,000, you're not great, right? So it depends on this spectrum. That's number one. I think language is so imperfect because we're lazy about marketing, because we want to be self-serving. And I get that. It's fine. But the audience has to understand it was self-serving. Number one. Number two, we don't talk about managed payout. we spend a lot of time talking about guaranteed lifetime income. I think we need to also talk about not every cent of your money is in an annuity. What do you do with the rest of it? Right? Now, there is a fear that a lot of conflicted intermediaries standing by the door waiting for somebody to retire so they can then take that money to do something that may not be solely in the interest of. And I'm not blaming them for not doing that. I'm just saying they most likely are not. I remember a friend of mine a few years ago, this is probably a decade or longer ago when interest rate was fairly high. He said, I just sold a big annuity. It's like $1 million annuity or something. I said, wow. I said, congratulations. That's great. He said, really help the client, blah, blah, blah. And it's 7%. I said, wow, 7% lifetime payout on $1 million. It's a lot of money. Oh, no. 7% commission to me. I know we're smiling inside, but I think this is where we are worried that we're at retirement, where most individuals have the biggest pile of money they have ever seen in their lives, all of a sudden available to them. They have no clue what to do with it. And they're going to believe in the guy who sits next to them in the pew at the church. They're going to believe in the next door neighbor. They're going to believe in the distant cousin or a good friend. Those are not the process of finding the right advisor for you, right? So I am concerned about that. If I spend the entire 40 years of accumulation to get them to that point, I don't think we should just kind of let the barn door open and say, have a good life. We should be thinking about how do we provide a portion of it in guaranteed income, which we've been spending all this morning talking about. But what about the other portion that's not in guaranteed income? How do we create methodologies that they don't have to leave? We can just continue to make paychecks. Then the question further beyond that is, are we spending down their principal or just living off the interest? People don't talk about that either. They bitch at annuity. Yeah, you're taking my assets and you're spending it down and I won't have anything left. But guess what? They're doing the same thing to the other side too. So we need to be very transparent. We need to be very honest. So we have the least amount of regret and the least amount of liability. If we really want to do the right thing for the people, we need to respect them as smart human beings who can make decisions. But it's up to us to explain it to them and allow them to make the final decision which direction they want to go.
Yeah. So I just wanted to say sort of that this idea that, at retirement, everybody sort of reached peak accumulation. There are all kinds of people waiting there, right?
Yeah.
Right. So it's not just people selling annuities.
No.
It's people selling sort of financial advice that's
Absolutely.
much more expensive than the financial advice that the participant was getting in the 401k.
Absolutely.
It's considered anybody in the financial services industry that's offering a retail product is there, offering their wares.
That's right.
So it's not unique.
That's right.
So I just want to make sure that.
I'm so sorry. I don't mean just insurance people. That's not what I was trying. I just used that as an example. I apologize.
I know.
I wasn't.
I know. But this brings us to this very important component that you sort of identified here is that to the extent that you're creating something in plan,
yes,
that continues not just to retirement, but through retirement.
That's right.
You give people, and again, thinking about managed payout, which is looking at the whole, right? It's the fixed part plus the variable part, right? The risky part. What you're saying is that at the end of the day, like you don't have that inflection point that's sort of fraught isn't there, which is good. And you give people the option to sort of stay in plan and continue to actually, be properly served in a cost efficient way without that sort of like that potentially conflict-ridden
correct
inflection point.
Correct.
Is that a fair?
You got it. Exactly.
Fair summary.
And I think we're not forcing everybody to do it that way. We're saying that should be an option readily available to individuals, and they may do that until 78, and they say, "No, I still like my next door neighbor Charlie. He's going to take the rest of." That's his or her preference, and I'm not going to judge one way or the other. But not having an option is forcing people to say, "You got to figure it out." And most people figure it out by saying, well, then I'm moving it out of here and I'm going to find somebody who can help me. Right? So I think as an employer, as a plan sponsor, as an industry, we're spending a lot of time talking about guaranteed lifetime income, which is critically important, but it's insufficient. It's only one sliver. What about the rest of it? And there are, as you know, products that take the entire kit and caboodle and say, don't worry about it, just give it all to me. Oh, okay, I'm going to give it all to you. I'll tell you, for example, you know this very well. Here's $1 million. No problem. I'll pay you 7% on $1 million. Wow. Until age 80, we'll drop it down to 4. What happened? Oh, because I'm spending down your money first. You want 10%? Great, we'll do 10%. We'll do whatever percent you want because you're just giving you your money back. And then when it comes to 80, that's when it's almost like a QLAC. It's almost like a longevity insurance where, oh, okay, now it's our turn to pay 4%, 5%, whatever it is. So I just think that we need to be really, really clear. What are we talking about here? Right? Yeah, it's nice you take all my money and you go make money on it. But this is not about you making money. It's about me getting a secure lifetime income that most likely I cannot outlive, or at least I have managed it as well as I can. And that is not talked about. I'm sorry.
It's finding the right mix. It's finding the right mix of
who is going to do that.
Guaranteed part,
sponsor
part.
Is more appropriate because we have been a tradition of fiduciary prudence because they are liable. And because they are liable, they worry. And because they worry, they try to be more cautious. And using the word that the Fed use all the time, measured pace. Measured, right? Sales is not measured.
No. Well, hey, listen, look, this is a great discussion. Ramsey, we got to keep this going. Unfortunately, I don't want to be the bad guy here, but the clock is right almost at the top of the hour. Ramsey, any last questions or comments here?
Look, I think we covered the many of the critical issues. It's obviously there's a longer conversation, but the key things from my perspective, and again, so Philip and I operate in the same space, right? And the idea is that you want to bring guaranteed income as part of a broader solution to the broadest possible audience. And the best place to do that is in the workplace. And there are a lot of things you have to solve for, right? You have to solve for returns. You have to solve for getting the right balance, right? So this idea of using 5 factors helps get you there. You have to have the right participants. So I should say vendors. So call it the carriers, asset managers, et cetera. So that's the work that we do. And Philip has done some really, really fantastic work in thinking about some of the critical issues. And again, thinking about it with the idea of what's this going to mean to the plan participant over the long haul. And I think that's the way we all should approach it. That's certainly the way we approach it at Alex Income. And I'm just delighted to have had the chance to have a peer join us on the show today.
You are very kind. Both of you are very kind to me and allowing me to pontificate what I'm thinking about. And hopefully we have found some common ground. Sounds like we have. And at the end, we're trying to do the best for those who are unable and willing to fend for themselves, that we take a bigger role. And I think that's an important role that we have. So thank you for the time today. Yeah.
Hey, thank you, Philip. And listen, thank you so much for sharing us some very thoughtful commentary and questions for people to ponder. We definitely have you back.
Thank you.
Where's the best place for people to stay in touch with you? Obviously, LinkedIn. Correct?
LinkedIn is a good place. You can go to, if you're interested in that IGPS, I'm not promoting it, but it's just something you can think about. It's called www.igps.one. And I won't spell out experiential wealth. It's just nobody wants to listen to it.
We'll put it in the notes.
And, thank you.
Okay. Hey, thank you so much. And I want to thank our listeners. Be sure to rate us, leave us reviews, share this episode, and most importantly, come back next week for another great episode with That Annuity Show. Thanks.
Nassau Financial Group is always working harder to be your carrier of choice. We build products that help protect people's savings and are dedicated to providing you with best-in-class service. We seek to keep things simple and have your back in the years to come. Nassau is headquartered in Hartford, Connecticut. Learn more at nfg.com.
Zinnia, an Eldridge Industries business, simplifies insurance. It delivers comprehensive solutions for the industry's most critical needs and creates the modern rails of the insurance industry. To learn more about Zinnia, please visit zinnia.com.